Welcome, everyone, and thank you for joining our webinar today, Guarantees versus Growth, the annuity conversation advisors need to master in 2026. I'm Cheryl O'Connor, CEO and co-founder of IncomeConductor, and it's my great pleasure to introduce our presenters today who represent a unique combination of academics and experience. Phil Lubinski has spent over 35 years as a financial advisor and certified financial planner, serving almost exclusively retirement income planning clients. Phil was the first to develop a bucketing approach to income planning and has trained thousands of advisors on his strategy. After successfully transitioning his practice, he co-founded IncomeConductor LLC and co-developed IncomeConductor, the best-in-class time-segmented retirement income software. He serves as the firm's retirement income specialist, contributing his expertise in the areas of advisor training, case design consultation, and product development. Myles Womack started his career in 2013 at Curian Capital LLC, an asset management arm of Jackson National Life Insurance Company. Since then, Myles has held several positions in sales and technology for National Planning Holdings and LPL Financial. He now serves as Senior Vice President of Advanced Planning and Platform Enablement for Jackson, where he and his team are committed to helping clarify the complexity of retirement planning for financial professionals and their clients. Welcome, gentlemen.
Thanks, Cheryl.
Thanks. I'm going to, just to not distract the audience from Myles and mine's, rugged handsomeness, I think we should turn our videos off and then we'll put them back on when we answer the questions at the end. So just to set the stage today on our agenda, the first one there, evolution of annuities. I guess it's not so much the annuities themselves, but just kind of the environment around the development of specifically the income annuities. And then we'll talk about some opportunities based on some really cool studies that have come out, but also some problems that are surfacing. And then just how do we position annuities? It's hard sometimes for clients. I know in my practice, when you just kind of verbally describe an annuity, number one, they may have a preconception of exactly what that is, but they can't picture, how does this fit into my retirement income planning? And then I've got a case history that I want to go through and just kind of step through it to give you some ideas of not only how the software works, but how you can visually really do some cool things with the annuities. So, as far as the evolution, I want to build a little more color around this, because if we look back at the markets, the boomers, the boomers are who are in retirement now, transitioning into retirement, but they really lived through, and being one, I can certainly attest to this, 4 of the worst market downturns in history. So I want everybody to think back to October 1987. I don't know, Myles, you were probably suiting up for a Little League baseball game or something at that point, but
All right.
I had actually finished my 10th year in the business at that. So boomers like me were turning 40 years old then. And that's about the time then that they were changing their focus on their savings and more focused on retirement savings. And they immediately experienced their first market crash on October 19th. And on that day, the U.S. market had a single day drop of 22%. And it was, I don't know if fondly is the right word, but it was termed Black Monday. And then just 10 years later, October 1997, there was another drop, not nearly as severe as Black Monday, but now this 50-year-old boomer experienced a 7% single day drop in the market. And then just not even 5 years later, the dot-com bubble burst, wiping out trillions of money in market value. The first two drops that we just talked about, I mean, those had very quick recoveries. But the dot-com crash, and that was a prolonged bear market, began in 2000 and continued through 2003. Then, just 5 years after that, the global financial crisis hits and the stock market dropped nearly 50%. The second worst decline since the Depression, and took 5 years, depending on how you were invested, sometimes longer than 5 years to recover. And now the boomers are 65 years old. So the decade when the boomers went from 55 to 65, that 2000 to 2009 was referred to as the lost decade. And it was the second worst next to the Depression. So I guess, is it any surprise that boomers are worried about their investments being able to sustain them through retirement, and outliving their savings became their number one concern. So the development of annuities, that eliminated, I guess, that downside risk and guaranteed income for life, it couldn't have come at a better time. The insurance industry was brilliant in developing that. And I forgot to turn my video off here. I've not always been complimentary of the insurance industry, but that was a mark of genius when they did that. So the first variable annuity with income riders anyway was in 2003. And they were simple at that time for both clients and advisors. I mean, the costs were transparent. Most of them had like a 6% benefit-based growth and a 5% guaranteed withdrawal rate. So they were easy to understand. Indexed annuities were becoming popular, and interest rates were low. Clients were looking for something that had some market exposure because the markets, but they didn't want to be in the market because of the volatility. And so they were looking, I guess, for yield without risk. However, the indexed annuities, then I think that kind of started introducing complexity around how they credited their interest, and words like spreads and participation rates and caps were introduced. And however the insurance company said they were going to credit interest, it could change any time even after the client purchased the contract. So you add to that then the bonusing annuities, the death benefit riders, long-term care riders, fees that weren't all that transparent. Now we have the largest generation in history transitioning trillions of dollars into retirement, and attempting to do it in this environment of fear and confusion. I don't know. What do you think, Myles? Am I off target there, or was it as graphic as I'm explaining?
Yeah, I think you've hit the nail right on the head, and I think I might be stealing a little bit of your thunder here, Phil, but I think even for people that haven't lived through market crisis or maybe don't think of it in those terms, they're always worried about something, and there's a lot of uncertainty around how they think about moving through retirement. A paycheck is really steady, and when I think about funding my own retirement, that's really hard to wrap my brain around, even if I'm a pretty smart person. So I think you couple that with any amount of experience with uncertain markets, and it gets to be pretty gnarly, and people like having some form of guarantee in there.
Yeah, I mean, that transition from a fixed paycheck that you knew what it was going to be every month and where it was coming from, to now what potentially could be a variable paycheck I know it's terrifying for retirees. So I mean, a big part of our job as advisors, we do all the number crunching, but that number crunching has to result in something that creates a high level of peace of mind in the client, so that it gives them the courage to go ahead and proceed with their retirement, and hopefully the confidence in us as the advisor to manage that along the way. But all of this, has some opportunities. I mean, if anything, adversity like that, it teaches us that crisis leads to opportunities. So if we look at the opportunities for advisors and firms, Global Atlantic conducted it was an online nationwide survey. It was 1,000 investors. They were between the ages of 55 and 75, and kind of that mass affluent. They had around 250 to $2 million of investable assets. And the group that they worked with currently worked with a financial advisor. So the purpose of the study was to examine the attitudes of these investors toward, issues that could possibly impact in 2025. What were they most concerned about? And number one, it was protecting their income and not running out of money. Over half said that protecting their assets was now more important than growth. And they reported that the best thing their advisor ever said to them was telling them that annuity would be secure and with them until the day they died. So this survey is showing, even long after all these horrible events that we talked about, that issue is still lingering. I mean, this group of people and people retiring today, they haven't forgotten the 2008. I mean, human behavior is such that you tend to remember the bad things a lot of times more than the good things.
Yeah, I'd chime in on one thing there. I was looking at a study not too long ago from LIMRA, Phil, where they were looking at, asset spending levels by wealth and various factors. And I was struck by the fact that 40% of multimillionaires in retirement, these are people with, investable assets over $2 million, were spending less than $100,000 a year. And that's including their Social Security and everything else. I think if we think about people with a multi-million dollar nest egg, they could probably afford to be spending more in retirement. And when they look at those people that were probably underspending relative to their assets, they were more likely to be, female. They were more likely to also have not confidence that their money is going to last that long, right? So this isn't just a, hey, I don't have a lot of money problem. This is a problem for people at all wealth levels, including probably a lot of the clients that you work with and want referrals from to find more like them. So just something else to think about as we move through our time today.
Yeah, I know some of my biggest challenges was getting my clients to spend their money. But when you think about it, people that have a lot of money, it's because they had a good habit of savings. And habits are hard to break, good or bad. And so to break out of that savings habit, I mean, I have clients who would bring me their budget and say, I'm part of my expenses are I'm still going to save $500 a month in retirement. And I'm thinking, what? No, this is the time to spend, not to save. So that's I saw that all the time where they would underspend what their assets were capable of doing. This study, there was a study that was called the Protected Retirement Income and Planning, and it was done by Ipsos and the Alliance for Lifetime Income. It said that more advisors are turning to annuities to address clients' concerns. I'm confident Ken Fisher's just right on the verge of making that transition into the retirement. So I'll be happy to see what his ads say. But it cited that the clients increased concerns about market volatility, inflation, high interest rates. 65% of financial advisors surveyed said that they've altered their financial or their retirement planning strategy just in the last year, with half of them saying that annuities, they were going to be using those for the first time. That was the single most identified change. What we're seeing at IncomeConductor is a significant number of advisors changing from traditional financial planning software and really adopting softwares that are retirement income planning focused. And also, which this is music to my ears, moving away from that probability-based strategies to those that are really defining that acronym ROI, return on investment, and they're redefining it in retirement as reliable ongoing income. So we got new softwares, new strategies, new product solutions. That to me is what's defining the retirement income specialist of today. But there are some problems. So J.D. Powers did a study in October just last year called the U.S. Individual Annuity Study. And overall customer satisfaction with individual annuities declined. Um, and it was driven primarily by frustration among newer clients early in the relationship and challenges, with all the digital channels. Customer understanding of key product details significantly declined, even as client experience in other areas of the industry and other sectors was improving. Experience and satisfaction with annuities was declining. Steve Randall summarized the problem in an article that he did for Investment News, and he just said, quote, the report suggests that advisors need to proactively guide newer clients through the first month of their annuity relationship, clarifying product mechanics and reinforcing their role as a trusted guide, including ensuring that the contract and fees are explained and understood. Myles, I don't know if you'd agree, but in addition to having my Series 6 and 7, I also have a Series 24, which is the supervisory license. And when I go to the regulators' websites and view client complaints, a high percentage of them have to do with annuities. Would you agree with that?
Yeah, I think certainly the more complex any product is, the more likely it is for a customer to not understand it, and ultimately that's what leads to complaints is when the customer doesn't understand what they own or why they own it, right? And I think the insurance industry hasn't always done a great job of creating simplified product designs with kind of transparent pricing. I think things are getting a lot better on that front though, and it's certainly something that we've been focused on the last few years here at Jackson as well. But yeah, certainly there are risks there if customers don't know what they buy, no matter what the product is.
Yeah, and I think it's consistency of how present a product. It doesn't really matter which company's product you're presenting. If
Hmm.
I'm doing it the same way all the time, even when a complaint comes in, I'm I think I'm much more defensible by saying, look, here's how I always present the annuity. The client is
Yeah,
saying I didn't do something. Well, that's not possible because
yeah.
I always do it this way.
Yeah, and I think also, I run a team of folks at Jackson. We were the first in the industry to have a team like this that's focused on helping advisors understand how the annuity fits into the financial plan and how to really model it. That's one of the reasons I'm excited about IncomeConductor's new developments and to incorporate annuities in is because that's something else that helps. Annuities are really hard to understand in a silo of all the different features. If you've looked at annuity prospectus in paper form, you'll know why you can use it to keep your door propped open on a windy day. But when the customer understands and sees what purpose the annuity serves in their larger financial plan to get them to the goal and the outcome that they want to reach, it's a lot easier for them to understand. They don't have to understand every roll up and every withdrawal percentage and everything else. But if they do see, yes, this is where it fits into my plan, and here's how it helps me achieve my goal, I think that risk goes down a lot.
Yeah, I totally agree. Um, so, we have, as advisors, we have uh, challenges, particularly the advisors saying, I'm kind of stepping into this annuity market for the first time in my career of really understanding how the products work. I mean, I know I've, some of my CE requirements, I've always signed up for the classes on, particularly on indexed annuities, and just because they're very complex to understand and then to try to explain it and communicate it to a client in a way that they can understand it as well. And as you said, how do we illustrate the benefits within the overall plan? So that's why, even though IncomeConductor has been around for several years, we just rolled out this new annuity modeling capability so that, as Cheryl said at the beginning and Myles has said, IncomeConductor is based on a segmented process where you're kind of dividing a retiree's life up into multiple time horizons. But annuities, don't always fit neatly into a segmented approach. So we wanted to be able to kind of pull them out of that process, create a platform so that you could model them the same, the way that you intended them to be used when you sold them in the first place. So when we get to the case, I just did a screenshot of, this is what we call the planning triad. And we're not going to be dealing with any planning issues today necessarily on this case. But the beauty of IncomeConductor is you're always on a single screen. It's unlike most financial planning softwares where you're scrolling from screen to screen to screen to do different inputs, get different outputs. It's all real time on this screen. And you can see over on the top right there, all the different things that you can model on this screen, annuities being one of them. So right in the middle of the screen where that green arrow is the annuities tab. And when you hit that tab, then what comes up is basically asking you, because you're going to indicate that this is either an existing annuity that the client already owns, or it's one that I want to propose to the client to purchase. So it's going to ask you, what is the purpose? How are you going to use this annuity? So, are you going to take fixed withdrawals from it? And when you think about, because all the tax rules are built into this, if we're dealing with non-qualified annuities, they've certainly got some quirky tax laws. So is it going to be a fixed withdrawal because you're going to use this annuity to cover maybe some payment on something? Or did you just sell it and at some point, either now or later in the plan, you just plan on withdrawing from it as you need the income? Or is it, truly a period certain annuity? Is it a SPIA type of an annuity, either a short-term or a long-term type SPIA? Or is it going to be a rider, which, typically is going to be the lifetime income rider? Or, we have a lot of advisors that they really don't have a specific income need in mind yet for the annuity. It's either like a non-qualified where they're trying to get the client to take some money out of the bank that's throwing a bunch of interest on their tax return and shelter it, or it's part of their overall asset allocation. And they're saying this is really kind of representing the fixed portion of the asset allocation. So how it illustrates. So I promise you we're going to go live to the website, but this is Jackson National's 5-year MYGA. And so this would be an illustration where you're saying, I'm going to buy this thing up front. It has a 5-year surrender period on it. And so starting in the 6th year of the plan, I'm just going to draw income from it as needed. And I'm planning on it covering that next 5 years, that 5-year period. So visually, this is what the client would see right on the website. So they see the rest of the plan. So this particular screen is under, you see on the top here, the income illustrations, and then by source. So we've got all different ways that you can look at the plan, slice and dice it, but clearly the brown jumps out and the MYGA's right there, or the lifetime income rider. So on this one here, I'm looking at that income assurance product of yours, and assuming here that we're holding it for the whole 10 years and collecting the benefit base growth, the step ups, and then throwing the income. But you can see visually, the client now sees, oh, okay, there's my Social Security. That gray, that's, I'm going to be drawing from other investments, and there's where the annuity fits in. And while we're on this income assurance, I find it to be, one of the more easier to understand lifetime income rider annuities. But do you want to take a second and describe that, Myles?
Yeah, and I'll tell you a little bit about the product features real quick, but then I'll make it really easy for everybody as well, or I'll do my best to make it really easy. The product itself is a great product. It's a fixed index annuity, and it's really designed for income. It is designed for cash flow and to have really predictable cash flow. So with the benefit base initially has a 30% bonus. So the benefit base, if you put in 100,000, is automatically going to be 130,000. that's going to roll up at 8% compound for 10 years. And then depending on, when you start withdrawals, how long you've owned the product, uh, you will have a withdrawal percentage. It's a relatively rich product. It's been very popular with the financial advisors we work with. Now, I know I just gave you a lot of moving parts in how we calculate the income, and I think that's again one of those scenarios where we tend to get bogged down in the weeds. We do have a tool on the Jackson website. If you go to Jackson and find the Jackson Income Assurance product, there's a tool on there called the Income Tool. Once you go onto the product page, and you can just say, hey, here's how much I want to invest. Here's how long I'm going to defer, and it will tell you exactly what you're going to get out. And the great news is it's going to be that. Because it's an index annuity, the caps are set such that you're probably not really ever going to beat that 8% roll up. So you've got really predictable, really stable income that you can build into the client's plans so that they understand what they've got. I think this is, again, one of those scenarios where you can tell somebody what time it is, or you can tell them how to build a watch. And what we need to do is tell them what time it is when it comes to doing income planning with annuities.
And that's an 8% compounded roll up, right? Not simple.
Yeah, that's an 8% compounded on top of the 30% bonus. So it's, you put in 100, it's 130, and that's compounding at 8%. And then the withdrawal percentage depends on your age and how many years you've been in the product. It's a really fantastic product. If you're shopping for lifetime income right now, it's worth taking a look at. And I know that there are a lot of folks on this call who are fee only financial professionals. It's available in both a commission-free version as well as a product that carries a commission and a yield to the broker that way. So compatible with all sorts of business models.
So when we look at this case, we'll see how it, when you said it's a rich product. So here's our case. This is Robert and Leslie Jackson, both 65 years old, and they're going to be retiring next year, first of next year. They projected to have $2.9 million in assets, and a lot of it is qualified money, and there is an inheritance that they received several years ago that has a relatively low basis on it. Their income, their sources, their combined Social Security is a little over $4,000 a month, and they plan on taking it right away. There is a Social Security optimizer built into IncomeConductor, but people today, particularly, I mean, they're kind of saying, I'm going to grab the Social Security just as soon as I can. Health-wise, Leslie's in very good health, but Robert does have some minor cardiovascular issues. So their question, like every retiree's first question is, do we have enough? Because we want to maintain a little over $10,000 a month net of taxes lifestyle. And their concerns is that right now, their only guaranteed income is Social Security. And they're worried about short-term markets. I mean, what's funny, it doesn't matter what the markets are currently doing or what they've done over the last 5 years. New retirees are always concerned about short-term markets, whether we just came out of a bear or whether we're in a bull market. And then they both know that Leslie is going to outlive Robert just due to their health situation. I mean, she's going to, actuarially should outlive him being female, but with their health conditions, that she's going to be a widow for some period of time. And so they're worried about her needs as a widow. So with that, I'm going to go right into the software. So this is that planning triad. And this is the first scenario. So you notice I don't have anything segmented here. This is kind of like if you were running a Systematica, an e-money type of a plan. And this page is just showing their spending. So that $10,000 per month, if we look at the spending, it's a combination of a core. So there's $7,200 that they say we know we're going to have those expenses the rest of our life. But we want to do some extra travel in the first 5 years. And we've got a mortgage payment that by the end of 2036, it's going to be paid off. Then I always create what I call a survivor core. At least what I found in my practice was that a surviving spouse usually doesn't need 100% of what the two of them needed together. So by the time, Robert is projected to die, their travel's behind him, the mortgage is paid off. So we're really down to just this inflation adjusted core. So that's what this 6,000 is it's saying that Leslie's going to need, somewhere close to 80% or so of that. And it's totally flexible. Nothing is set up by default. But what you see over here on the left in this planning triad um, is that are these summary boxes, which are looking at the total plan. And the very first question they had was, do we have enough money? Well, here in this assets box, it's saying, geez, guys, you not only have enough, you've got $1.2 million more than you need. Now, what IncomeConductor does is when there's a surplus, it kind of carves that out and allows you to say how you're going to invest it, what rate of return you think it's going to earn. So what I did with this, since this is not a segmented plan, I just assumed overall everything's at a 6%. So it's kind of like, most financial planning softwares where you just give it a portfolio rate of return. So if everything does 6%, then that surplus would grow to an ending balance of $5.6 million. So they're going to leave the kids twice as much, almost twice as much as what they started with. So the next view then is dropping in actually 3 different annuities here. So you notice this blue color. What I used a lot when it was appropriate and worked with the numbers well for that first 5 years would be a 5-year SPIA, and just get that income guaranteed and not have to worry about the paycheck. It's going to happen like clockwork. So you see over here in the legend, that blue is the SPIA. Then, as we saw in that screenshot, then the MYGA drops in. So it's been growing for 5 years, and then it produces its income. And then the red is the Jackson National Income Assurance that now is going to be paid for the rest of their life. And when Myles was saying it's a rich product, remember before, the ending balance, now I'm still assuming on everything else the same 6%. And I'm just using the actual quotes from Jackson on what the SPIA, the MYGA, and the income assurance would produce. And that income assurance annuity, let's see if is coming in at $7,500 a month. No, that's the first one. That's the SPIA. It's coming in at $2,761, and all I put in it was $250,000. So these were the total deposits into those 3 annuities. So we got 7, 8, little over $1 million. So we're well below, a compliance limit on how much can go into an annuity. But look what happened over here on this ending balance. Remember before it was like 5.8 million, and now it's $7.1 million at the end of the plan. So by layering in those guarantees, we not only gave the client a great visual, but also there's a tab here where you can look at the full plan detail. This is the spreadsheet, and sometimes you may want to show this to your analytical clients. But wouldn't it be nice to show the client, because this column here that's labeled withdrawals, that's saying here's how much we're going to have to be withdrawing from your investments, from that bucket of money, if you will, that's market dependent. And look, because of the SPIA and because of the MYGA, that zeros all the way down through the first 10 years. Then it's from 2037, we've burned through those 2 products. Now we're drawing from investments, but the investments have had 10 years to grow. And so when clients say, I'm worried about the short-term markets, usually I want to make sure it's the short-term. And if somebody says, I'm worried about the long-term markets, then we got a whole different discussion, because if they're worried that the markets are going to go down and stay down and never come up, then we got much bigger problems. We got a world collapse. So it's always the short term. And I always said to clients, look, my research tells me that given 10 years or longer, the markets are always going to reward you. And so that risk, that fear of losing money really should go away after 10 years. So here we've clearly insulated them during that first 10 years. Now,
Yeah, and that's really where sequence of returns risk is present, right? It's in those last 5 years of savings and the first 5 to 7 years of retirement, Phil. That's when the risk is highest. If there is a bad market event or a downturn, like we kind of talked about, that you've seen a few of in your career, that's when mathematically you're going to be creating a hard time for the client. So having the insurance bubble wrap here essentially around this kind of fragile decade in retirement makes a huge difference for the ultimate outcomes and makes them much more predictable.
I've had a lot of advisors say to me, "Well, hey, Phil, how's that segmented thing? How'd that hold up if the client had retired in 2004 or five? So the bear market of 2000 was behind them, but nobody saw that next one coming." Well, they did great. I remember, like in 2009, all the articles in the newspapers were about retirees who were planning on retiring in 2009, 2010, and now they're fearful that they're going to have to work for the rest of their life. And the reason being is that they did not prepare their portfolio for retirement, in my mind. They just left it fully invested and absorbed the entire drop of 2008, where the clients that used the segmented approach that retired in 2005, they were fine because we, like you said, we took them out of that danger zone, and that market didn't impact their income. They got their checks, just like clockwork. Now, the third one here is where I did segment the assets. And what's interesting is I want to make one change here. I thought I had.
While you're making that change, Phil, I will address a question. The FIA products are not available in New York. They're available in all the surrounding states, Connecticut, New Jersey, et cetera, and as well as Florida. But the FIA product is available there. The SPIA and the MIGA are, though, Stephen.
Oh, okay. So what I did on this one, because with segmentation, so I made segments kind of based on their changing expenses. So this first one is 5 years because they had travel the first 5 years. Then I made a segment when the mortgage was paid off. Then I made a segment when Robert was projected to die. And then isolated a segment for Leslie. And I really encourage you to do this when you use segmentation, because one of the things that a lot of us don't think about is, number one, clients don't die at the same time. I mean, that old myth that retirees die within months of each other is just that. It's a myth. There was a study done a couple of years ago that showed that the average life expectancy of a surviving spouse, and 90% of the time that surviving spouse is a female, the average life expectancy, so these are deaths after 65 years old, is 12 to 13 years. So what happens at that point is, everything looks fine. The tax planning looks good. The first spouse dies, and now that surviving spouse is filing as a single taxpayer. And even though her income may be less, her needs may be less, the income doesn't change much. And the RMDs can be, without proper planning, causing havoc, where all of a sudden she's in on that one screen. There was a thing that was called the L-gap tax trap, the longevity gap tax trap. This will flush that out and show that we need to be doing some stuff back here at the beginning of retirement to avoid that surviving spouse being in a jam. But also with segmentation, because you're assuming that each one of these segments is a product or a portfolio of its own, each one would have a different rate of return. And the logic is that the short-term money would, you would be chasing a lower rate of return, and the longer-term money, you would be chasing a higher rate of return. Well, the default rates of return on IncomeConductor, if we look in the segments tab, it just goes 3, 4, 5, and 6. So the only money that's chasing the six that we were illustrating in those other two cases is just really Leslie's money here. But so now you say, aha, that segmentation doesn't work so good because look at that ending balance where before we were up over $7 million. Now it just dropped to 6.8. So, that's not good. The client had a goal that they wanted to leave as much as possible to their kids. But the logic, think of the accumulation side. If a client came to me and they were 35 years old and they said, we've got three goals. We need, a chunk of money in 5 years that we're going to use for a down payment. And then in 12 or 13 years, we have to educate our child. And then we want a pot of money for retirement. We wouldn't invest those three goals the same way. We wouldn't put them all in one portfolio and then just take from it as we cross over those goals. And yet I've never understood the logic of why you with a financial planning piece of software that you would use a single portfolio rate throughout somebody's retirement. And when somebody says, well, because it lines up with this, this risk score that I got. Well, people's risk tolerance changes based on their time horizon, I think. It certainly changes based on what's going on in the markets. You give somebody a risk tolerance test in 2009, their risk score was a whole lot different than if you gave one to somebody, in 2000, just after we came out of the best bull market in history. So I don't put a lot of confidence in a risk score, but I do put confidence in that the longer it is until I need the money, the more aggressive I can get with my assumptions and the more aggressive I can get with the portfolio that I'm going to use. So in this case here, here's what's interesting. If we wanted to change these rates of return, because these are not net of taxes, they're net of fees and advisory fees, but still pretty conservative. In fact, we back tested these to a 90% probability of success. But the logical place where you could change the rate of return would be this last bucket. And watch what happens if I just change that from 6, I just move it up 1 percentage point. I don't think anybody'd think that way. That was really an aggressive move, Phil, on your part. And I saved that. That ending balance just jumped to $8.5 million by just taking a little more risk. And I'm sure you agree with this too, Myles, that the more guaranteed income someone has, the more courage they have to take a little more risk with their money. Is that consistent with what you're reading, Myles?
Yeah, I think every client's unique, but I think they definitely have more risk capacity the more guaranteed income they have, right? They are mathematically better in a position to withstand some market fluctuations. There's no doubt about that. And at Jackson, with our open architecture within our variable annuities, and we're not really talking about those, but we do see people investing a little bit more aggressively inside a variable annuity than they would otherwise. If they were a moderate investor, they might go up a notch on the risk spectrum and have a moderate growth portfolio if they've got an income guarantee in that annuity, for sure.
So now we've got the income view here. So we've got the SPIA, we got the MIGA, we got the lifetime income, and then we bumped up that that rate of return on that last segment, up to from 6% to 7%. So if we were to just kind of go back to our PowerPoint here and summarize what did we actually accomplish? Let me get it blown up here for you. So in all three of these scenarios, we started with the same $2.9 million. And the income goal was the same on all of it. The goal over there, taking that 10,500 and then adjusting it, and I used a 3% inflation rate, was 3.6 over the life of the plan. And then the ending balance. So the systematic withdrawal using that 6% overall assumption on everything, left a balance at the end of $5.6 million. Soon as we threw in the Jackson products, that ending balance, everything stayed, they got the income, their income goal, but that ending balance jumped to 7.1. Then we bring in the segmentation, which just brings some logic into the plan. The discussion around segmentation just makes sense to the client. And by only adjusting one pool of money by that 1 percentage point, and the pool that would not affect the client's income at all. So regardless of what that legacy segment that was going to go to the kids did, Robert and Leslie's income was not going to be impacted at all. We bumped it up to $8.5 million. But something else that this is an interesting discussion to have with a client. When you're evaluating a corporate or a stock, there's one thing that you look at is the PE ratio, the price earnings ratio. Well, I think retirement income plans have a PE ratio as well, and that's protected versus exposed income. And remember, in their goals, they were kind of concerned that their only income guarantee was Social Security. I mean, when I started in this business, 85% of retirees had defined benefit pension plans. And if they'd been with the employer for a long period of time, typically those would pay out 50 to 60% of what the client was making while they were working. And they had tremendous confidence in Social Security. Now, the numbers have reversed. 85% of people retiring today don't have defined benefit pensions. And I would guess that 85% of the public isn't as confident in Social Security as their parents or grandparents were when they retired. So this PE ratio, the protected versus the exposed, is becoming more of an issue in clients' minds. So in that systematic withdrawal model, I mean, only 37% of their income over the life of the plan was protected. So almost 2/3 of it is going to be dependent on market conditions. And once again, think about all the market conditions that this group of people has lived through. That's what they're nervous about. When we go to that J&L implement plan, at the numbers, I mean, look at this, almost 80% of their income is protected. In fact, the way the numbers worked out was that their core expenses were part of that 80% that's protected, so that the only thing that would be in jeopardy, that 21% that would be in jeopardy if the markets didn't perform, were their discretionary expenses. So it drives me crazy when I read articles that say, just put it all in one big portfolio, and as long as you do the safe withdrawal rate, everything's going to be fine. And if the markets go down, then just adjust the spending. But you can't adjust it. You can't adjust the necessary expenses. I can't go to my utility company and say I'm going to pay less for the heat this month because the markets are down. But you can adjust your discretionary spending. And that's the ideal situation to be in. And that still represents a large chunk of money to put under management. So as an advisor, if you're saying, well, I've got my advisory fees and I want to have that revenue coming in. Well, as you saw in this case here, that money under management, if you did this particular funding, grew. A lot of advisors think that, and I hate the word decumulation, because retirement isn't the decumulation phase. Decumulation to me means that my assets are going down. Clearly, in most of the plans that we work on, the assets are either staying the same, or like we saw in this plan, they're going up significantly. So those AUM fees are going up in spite of the fact that you use some protected products and you may have taken a commission on those. And as Myles says, you don't have to take the commission option. So you can still have everything under an advisory fee. And the benefit of that then is the peace of mind, the thing we talked about right at the beginning. The biggest thing to sell to the client is the peace of mind, which then leads to the confidence in you, which then leads to you getting the business. So when they're positioned properly, guarantees do provide that peace of mind, and retirees crave it. And you're not sacrificing market opportunity. And by using the segmented strategy, then that market risk, it can be customized. and increase strategically along the way. And so the plan is still, it's inflation proofed. It can leave a significant legacy at the end. And I think it's much easier to manage that plan, to monitor the plan, and adapt it along the way with facts, with real numbers of, part of the tracking that we do within IncomeConductor is look on a regular, it actually looks on a daily basis as to what is the value of each of those segments and the portfolios that are in them, versus where they were projected to be. Are they underwater, overwater, above water? And what are our options moving forward? So your opportunity, the people on this call, I think, and I found you can attract much easier new clients. I can't tell you the number of referrals that would come into my office and they'd say, hey, I want one of those bucket things that you did for Harry and his wife. I don't know anything about it, but the way you described it really makes sense to me. So it's like I said earlier, it has so much logic to it. But this is also an opportunity to go back to existing clients and really deepen that relationship that you already have, and perhaps, redo their retirement income plan and get their reaction to how, they respond to this maybe a little different approach. And, advisors say, well, how do I go back to my client and say what I was doing was wrong? It's not going back and saying it's wrong. It's, here's a little different way. I mean, if my doctor comes to me and says, hey, Phil, there's a new prescription that I'd like you to try. I went to a conference I heard about it, and I think it might suit you better than the one you're on. I'm not saying in my mind, you gave me a bad prescription. Why am I on the wrong one? I'm glad that my doctor's staying current with what's new in the marketplace, in the medical markets, and they're keeping me current in my treatment. And
Yeah.
we have a lot of advisors, when using IncomeConductor, are being able, if they're not already, to charge planning fees. And I know all of us are looking for new revenue sources, within our practices. And clients are willing to pay fees when you do this kind of analysis and present this kind of a plan. And I can attest to this, having sold my practice, it does increase the value of your practice. When you have a repeatable process within your practice that's going to remain the same. When I sold my practice to my transition partner, the only thing that changed was the face across the desk to my clients. Nothing else changed. And the retention rate was 100%. She didn't lose a single client. And the clients were totally comfortable because everything stayed the same, the reports stayed the same, and it was consistent. And this creates that kind of consistency. So next step, I'd said at the beginning, one of the things that we're going to offer everybody is just a free trial of IncomeConductor, but with it, a case design meeting. So that the trial would mean that you just pick a client of yours that's either very close to retirement, maybe already in retirement, and I'll help you build the case for them. We can role play it and talk strategically. How would you present it? And present it to them and see what their reaction is before you make any decision whether you want to add another expense, another technology to your tech stack. So this QR code, it will take you right to the site to do your free trial. We don't take any credit card information, so don't worry about, you get your trial, it expires, and then there's a gotcha because you get charged. That's not going to happen. And also, if you want to get in touch with Myles and get more information about, some of the Jackson products and the newer products that are coming out and those fee option products, that's his contact information. But now I want to open it up for questions. And I think Cheryl was going to moderate the questions.
Yeah, so great presentation, guys. Interesting discussion. So let's move to some questions. We do have some from our audience. Adam asks, in both of your expert opinions, What amount of net worth or net investable assets is a true realistic minimum for annuities?
I'll hop in there a little bit, and I guess asking the annuity manufacturer this question is a little like asking the fox to guard the hen house. But Adam, I'm answering your question from the perspective of, hey, if somebody's only got $50,000 to invest, they've got bigger problems from a liquidity perspective. We don't want to tie their money up in something that could have surrender fees and things like that. Um, you know, I think it really depends on the individual client. Do they have other sources of guaranteed income? Do they have other sources of liquidity? Do they do a really good job of keeping their spending in check where they don't have liquidity shocks? Those sorts of things. You know, I would hesitate to really give an answer on this. Phil, do you have a thought on that?
Well, no, and compliance drives a lot of that too.
Yeah.
So, and that's kind of what you're talking about is how much liquidity are you tying up? A lot of times we get the question of, what's the minimum amount of assets to go down this segmented path? Because if I'm going to break a client's portfolio, total portfolio into kind of multiple accounts, I don't want to end up with having $10,000 going into a segment and all the paperwork involved with that. So typically, my rule of thumb was usually the client needed to have like 250,000 or more to really go into this approach. But we do have advisors that are setting up segmented approaches because you don't have to have three, four, or five segments. I mean, you can have a two-segment plan. IncomeConductor allows the advisor to create as many or as few segments as they want. But if you're really going to do a comprehensive retirement income financial plan, then there's a lot of work involved in that. And if you're not going to charge a fee, then I think there's got to be enough assets there. And that's kind of why 250 was, there's a lot of advisors that say if they don't have $1 million, I don't want to talk to them. That's a whole nother discussion.
Yeah, and I think if we inflate that a little from when you were practicing, Phil, I think what we're seeing is, probably around 500,000 or more on the system, but could go up to multiple millions. This is a great strategy for those high net worth clients as well.
Yeah, because our
So,
average, Cheryl, isn't it coming in at like a million, close to 1.5 million, 1.2 million
yeah,
now?
probably closer to 2.5 million right now. Um, On a practical day-to-day basis, what impact does the annuity have operationally to the advisor and client?
Yeah, I'll answer that a little bit from a client perspective because Phil's got the better client facing experience, I feel like. But I think there's a couple things, and there's another question that's in the Q&A that I think this touches on a little bit, um, which is the cash flow that it creates is really simple to administer. An annuity can be a little bit more burdensome up front at the point of implementation. But once it's implemented, the cash flow that it creates is automatic. You don't have to think about raising cash on a regular basis. You don't have to think about rebalancing and tax implications of that. There's so much that you don't have to think about when it comes to creating cash flow from an annuity. It makes up for it on the back end. It's a lot easier to own in a lot of ways than other income producing or other income focused investments.
We have a question from Mike. This is for Phil. So the bucket strategy never sees a sequence of returns risk anyway. So the protection of an income rider may be somewhat overblown if you use a true bucket plan. What are your views on that, Phil?
Well, I think the protection of the income rider is the longevity risk. So, so we're talking with the SPIA MIGA combination. And if in theory, if at the beginning of each segment you're buying another SPIA, then that segment's income is protected as well. So, you're absolutely right when you say that it's kind of protected along the way,
Mhm.
but the lifetime income is that longevity protection.
Yeah.
And
Oh, go ahead, Phil. Sorry, I didn't mean to cut you off.
no, go ahead.
The other thing I was going to say is all of you've got to assume a rate of return for any bucket that you've got in there, right? And the source of those returns could be capital markets type sources, or the source of returns and it could come from the longevity credits that you get inside of an annuity product, right? So to the extent that the annuity product gives me a better rate of return than what I would get baseline for some of those things, I do think it makes a big difference. And we can, if you want to get into a real nerdy discussion about that, whoever asked that question, pop me an email. I'm happy to hop on the phone and talk through that. But sorry, I didn't mean to cut you off there, Phil. I thought you were finished.
Oh, no. No, the biggest pushback I get from advisors, never did from clients, is the SPIA. Why are you using a SPIA? Why don't I just have a ultra conservative portfolio or treasury bills, money markets? And I don't know what the hang up is about a SPIA, other than they're saying, well, you're going to tie up all the money and it's going to get liquidated. But the continuity of income, I mean, think about it. When a client transitions from getting a regular paycheck every month for the last 30, 40 years, now into this new world of retirement, it's almost like when I graduated from high school and went to college, all the rules went away. I mean, my first semester at college, I was like a madman doing everything my parents didn't let me do when I was in high school. And I've seen clients do that when they transition into retirement and they have total control over all their money. And all of a sudden they go on this, spending spree. What I like about the SPIA is when I'm getting a paycheck when I'm working, I tend to live within that paycheck. And when I get a paycheck in retirement, they'll live within that paycheck. If I just say, hey, put in your checking account or put in your money market and draw from it as you need it, I've seen so many plans blow up because the advisor thinks it's going to last 5 years, and 2 years into retirement, the client calls them and says, hey, I forgot to tell you I bought a car out of that account and there's no more money left in it. Now what do I do? And you go, oh my God, that next bucket, that product isn't even ready to deliver yet. So I think keeping control of that income delivering product is critical.
Yeah. One of our wholesalers has a great one-liner, which is that a lot of times your money doesn't need a client's money isn't what needs the annuity. It's their mind that does. And sometimes it's permission to spend, and sometimes it's a governor on their spending, right? It just depends on what that client's needs are.
I like that.
So we have one more question while we're on the SPIA. Ben asks, how do you handle the SPIA payment in the first 5 years when it is set and the system shows a COLA adjustment just pulled from investments?
No, there are COLAs. I mean, you can buy SPIAs with COLAs.
Uh-huh.
So it used to be, I mean, way back when I started, that most SPIAs were just a flat income. And then if you did need an adjustment, you would draw from somewhere else to do that. But fortunately now SPIAs come with COLAs, so that problem is kind of solved.
Yep.
Wonderful. Well, we've come to the end of the hour. We're a little bit over, so we want to be respectful of our audience's time. Thanks again so much to Phil and Myles and all of our attendees for joining us today. I hope you've learned something important that will help you have a much deeper and more meaningful conversation with your clients about annuities, and also how to clearly show the value that they bring to their plan. And I also hope you take advantage of our 14-day free trial where we can work on a client case with you. So thank you, everyone.
Thanks for having me, Cheryl. Phil.
Yeah.